Welcome to the Deep Dive. We take the source material and extract exactly what you need to know.
Today, we're digging into Methode Electronics, ticker NEI, specifically their Q1 fiscal 2026 earnings call.
Yeah, and this one's fascinating because the stock just popped right after the report. A really sharp, constructive move.
Shares were up over 12% by the next close.
Which is interesting, right? Because sales were actually down.
Yeah.
So what exactly did investors latch onto? What thread did management pull that just completely changed the narrative?
That's what we need to unpack. That market reaction is the key. It tells you investors were looking straight past the year-over-year sales dip.
They were focused elsewhere.
Exactly. On the execution, the operational improvements, and definitely the balance sheet getting healthier.
Okay, so let's ground ourselves in the numbers first. Give us the top line and the bottom line snapshot.
All right. Revenue for Q1 came in at $240.5 million.
Okay.
Now, that actually beat the street consensus. Analysts were looking for something more like $233 million, so a bit of an upside surprise there. But yeah, still down 7% compared to the same quarter last year.
And profitability.
That's where it was a little softer. The adjusted diluted loss per share was negative $1.22. That slightly missed some of the estimates out there.
Right. So revenue beat, EPS miss, sales down year over year, and yet the stock flies.
Precisely.
So the takeaway for you listening is immediate. The market totally ignored the headline sales decline and the EPS miss. The focus was clearly somewhere else.
It had to be on the execution and the path forward, the transformation story.
Which management must have sold pretty convincingly then.
They absolutely hammered that theme. That the transformation plan is working, and you can see it in the operational leverage.
Okay, show us the leverage.
Adjusted operating income saw a really nice jump. It grew by $6.7 million compared to last year, hitting $2.7 million.
Wow, from a loss, presumably.
Yeah, and adjusted EBITDA also climbed significantly. It was up $5.9 million year over year, reaching $15.7 million.
Okay, hold on. Sales dropped 7%, but operating income and EBITDA climbed by millions. That's serious internal improvement. How'd they pull that off?
It mainly came down to cost control, specifically a big cut in SG&A selling, general, and administrative expenses.
How big?
About $9.6 million reduction compared to last year.
$9.6 million, okay. And where did that come from? Just delaying spending or?
Management pointed to lower professional fees and compensation costs. It seems tied to the restructuring efforts they've already completed.
Okay. So the argument is that these are more structural savings, not just pushing costs down the road.
That's the implication, yes. If those savings stick, then any future revenue growth should fall much more efficiently to the bottom line. That's a leverage play.
Makes sense. And it wasn't just the income statement they work on, right? The balance sheet was a big part of this positive reaction.
Oh, absolutely. Cash flow was really strong. This was their third straight quarter of positive free cash flow. They generated $18 million in Q1 alone.
18 million FCF in the quarter.
Nice. And that cash generation directly fueled debt paydown. Over the last 3 quarters combined, they've cut net debt by $41 million.
41 million. That's significant deleveraging. That definitely builds back some investor confidence.
He provides a much more stable foundation, takes some risk off the table.
Now, there was that reporting delay before the call. Caused a bit of noise. What was the story there? Anything serious?
It seemed pretty technical, honestly. Management said it was related to an old dividend calculation, basically an accounting error.
Nothing operational there.
No, nothing operational. It technically triggered a covenant breach related to restricted payments in their credit agreement, but it sounds like it was more administrative than anything else.
And they got it sorted.
Yeah, they got a waiver from their lenders pretty quickly. They emphasized prioritizing getting controls back in place, and the market seems to have just moved past it, focusing on the cash flow and debt reduction instead.
Okay, good. So financials improving, balance sheet strengthening. Let's pivot to the actual business segments. Where's the growth coming from, especially with North American auto, particularly EV, being kind of soft?
Yeah, that softness is definitely a factor. But the industrial segment was the clear bright spot in Q1.
And within industrial?
It was primarily their power products, specifically things like high-density bus bars going into data centers.
The AI infrastructure build-out effect.
Exactly. Yeah. The need for more power, higher power density for all that processing method seems to be capturing a nice piece of that with their components.
And management made a pretty big deal about their history in this space, didn't they?
Yeah.
To kind of validate their position.
They really did. It was actually quite interesting. They talked about their decades of experience in power distribution, like Like they supplied components, bus bars, for the actual Apollo lunar landers.
Seriously?
Yeah.
The moon landers?
Yep. And the original IBM mainframes way back when, their point was this deep expertise in handling power reliably is now super relevant again.
For today's high-voltage data centers, military applications, that sort of thing.
Exactly. And next-gen EVs, too, eventually. They're basically saying, we've been doing this complex power stuff for 60 years.
Wow. Okay.
Yeah.
So they're leveraging literal space-age tech heritage for the AI boom. That's actually a really compelling angle. It reframes them from just an auto supplier.
It definitely adds context to their capabilities in that industrial power segment. Now, looking at EV specifically.
Still important, right, even with the slowdown.
Oh, yes, still significant. It's about 19% of their total sales currently, up slightly from 18% last year. The softness is mainly North America. They mentioned seeing better trends in Europe and Asia.
But the big EV recovery, that's still further out.
That's what they're guiding to. They don't expect a major EV rebound until fiscal 2027.
So a couple of years away. What's the near-term outlook then?
Near term, they expect data center power sales to be kind of flat, mostly because Q4 of fiscal 25 was apparently a record quarter, so tough comparison. And overall, power sales will likely be moderated by that EV slowdown.
Okay, so if near-term organic growth is a bit muted, they need something else to drive results towards that guidance. Program launches.
Yes, that's the bridge. They highlighted over 30 new program launches scheduled for this fiscal year, fiscal 2026.
30 programs. Are they spread out?
Crucially, no. They said most of them are weighted towards the second half of the fiscal year.
Ah, okay. So that sets up for a stronger H2 performance.
Precisely. And that links directly back to why the market probably reacted so positively despite the weak Q1 numbers.
The reaffirmed guidance.
Exactly. Management stood by their full year fiscal 2026 targets. That was the big vote of confidence.
Remind us of those targets.
Sales expected between $900 million and $1 billion for the full year.
Okay.
And, more importantly, adjusted EBITDA affirmed between $70 million and $80 million.
Right. And connecting that EBITDA target back to where they've been, the implied margin expansion is pretty dramatic, isn't it?
It really is. If they hit that $70 to $80 million EBITDA on roughly $950 million in sales, that implies an EBITDA margin around 7.9%.
And what was it last year?
Last fiscal year, FY25, it was only 4.1%.
Wow. So they're guiding for a near doubling of their core profitability margin in 1 year.
That's the plan they laid out and reaffirmed. When you signal that kind of margin recovery path, investors sit up and take notice. It changes the potential valuation completely.
And they expect the cash flow to support this too.
Yes, they expect full year free cash flow to stay positive, continuing that balance sheet repair trend. And again, with the program launches weighted to H2 and the cost savings kicking in.
The second half is expected to be much stronger than the first half.
That's the clear message.
Okay, so if you're tracking this turnaround story, what are the key things to watch over the next, say, 2 or 3 quarters?
I'd say 3 main things. First, just watch the quarterly numbers. Are they actually hitting the milestones needed to reach that $70-80 million EBITDA and positive FCF for the year?
Yeah.
Is the margin expansion happening?
Execution proof.
Second, look for more news or color on those data center power wins, especially the higher voltage stuff they talked about. That's the key growth engine right now.
Visibility on the growth driver. Makes sense.
And third, keep an eye on the broader economy, specifically signals about that North American auto and EV demand recovery. If they can keep delivering margin improvement even before that recovery kicks in, it's a very strong sign.
Got it. Progress on targets, data center wins, and how they navigate the macro. That definitely sets the stage.
Okay, now we get to the fun part.
All right. Before we jump into the trade ideas, the standard reminder. This next segment is purely for informational and entertainment purposes. It explores a potential thesis based only on the information discussed today from the earnings call.
It is absolutely not financial advice.
We are not recommending you buy, sell, or hold any stocks. Investing carries risk. Always do your own thorough research. Okay. Let's hear the pitch.
Adopts hedge fund pitch tone. All right, the play here is long MEI, but it's a specific bet on the timing and pace of the margin recovery. The core thesis is that the market is still underestimating how durable those $9.6 million SG&A cuts are and how quickly they'll translate to EBITDA improvement, especially as those H2 programs ramp.
So you're betting they hit the targets, maybe even sooner or more strongly than expected.
Exactly. We're front-running the shift in narrative. Right now, it's still seen partly as a turnaround. We're betting that by Q2, definitely Q3 earnings, the focus shifts decisively to profitable growth as the EBITDA numbers start strongly reflecting that 8% target margin run rate.
Even with the EV softness.
The EV softness in North America is known. It's baked in. The data center bus bar strength provides the near-term floor. The upside comes from the leverage. The outrageous part of the pitch isn't that they hit the guidance, it's betting they hit the required quarterly cadence for that guidance aggressively, potentially causing estimate revisions sooner than later.
And the risk side.
The balance sheet risk is significantly reduced thanks to that $41 million debt paydown. It gives them breathing room. The main risk is execution if those SG&A savings aren't sticky, or the program ramps slip. But the trade is essentially a volatility play on management hitting their operational marks faster than the consensus models currently reflect.
A focused, aggressive bet on near-term execution, delivering ahead of schedule. I like it.
It hinges on that SG&A leverage being real and immediate.
Okay, fascinating stuff. So to wrap up our deep dive on Methode Electronics Q1 call, the big story wasn't the sales drop, down 7%, or the slight EPS miss.
Nope. It was all about execution. Strong free cash flow, that significant $41 million debt reduction over 3 quarters.
And crucially, reaffirming that full-year guidance, which implies essentially a doubling of their EBITDA margin year over year.
That's the core takeaway. They successfully shifted the narrative from headwinds to operational control and margin expansion.
Which leaves us with a final thought for you to consider.
Right. Given that Methode is now explicitly linking its historical power expertise, stretching all the way back to the Apollo program with the huge modern demand for higher power density in data centers.
Driven by AI and everything else.
Exactly. How much bigger can that industrial power segment actually get? Could it grow beyond the current guidance? And if so, at what point does that potential force a fundamental re-rating of the entire company's valuation?
That pivot from legacy tech to enabling the future of computing power,
Yeah.
It's definitely something to keep watching.
For sure.
All right, that's all the time we have for this deep dive. Thanks for joining us. And remember, always do your own research.